All right, can everyone hear me? Let's do sound check, and if you can hear me, please let me know. Testing sound. Okay, Dan, I'm not sure if there's a problem with the sound. Am I being heard or not? Okay, good. My goodness, technical. I love technical challenges. All right, I just want to make sure now that you can see my big screen, hit the Mark Trading logo, and then I think we're ready. One other thing is that we are recording this. I know some people are asking if we're recording. Absolutely we are. So good morning to everyone. Hi, Jay. And I'm really excited to talk to you. I've got a lot of slides, so we might be fast-paced, but please bear with me. And I do want to answer all the questions. My email, I'm going to type my email, because if you have any questions, you can certainly write me. martin@hitthemarktrading.com. Okay, good. Let's go on. Now, I want to thank Agena Trader for presenting this. We're doing 3 webinars, actually. And June, July, and August. We're going to talk about day trading first, and then in July we're going to talk about using the same methodology for position trading. And listen, if you are into stock trading, options on stocks is the place to be for great leverage. So I might delve into that. And then in July, July is notorious for being a very tough month, especially equity index futures. So I'm going to be talking about what's really working, okay, and what we're doing for the trading. Let me give this disclaimer. We are all adults here. Trading financial instruments using contract stocks or options is extremely risky and not suitable for everyone. Only trade with money you can afford to place at risk. Past results do not guarantee future results. Please consult a licensed professional prior to trading using real money. I am not a licensed professional, and I'm big on paper trading. Please paper trade any new concepts. All right. Just briefly about me, I've been doing this over 25 years, over 10 as a full-time trader. I launched a newsletter in 2008 for teaching. Went to video format based on client request. I typically hold about 4 boot camps a year, sometimes 5. I've got experience trading a lot of instruments: stocks, options, bond, futures, forex, Japanese bonds. I mean, the only thing I have not traded, I have never traded this Bitcoin deal, unregulated, dangerous. And for forex, I prefer currency futures, not forex pairs, but I have no problem if you do that. Various indicators experience, and I've spoken at various trading conferences and provided webinars, lots of webinars, promoting relaxed, simplified trading. This is me, and that is taken in my home. So behind me, one of about, I don't know, 300, 500 orchids, great in Southwest Florida. This is my trading room at the house. I have a little office now because the internet was so terrible, but that's the trading setup at the house. You can go to the website to find out more about what I try to accomplish, but basically I call trades, you watch them unfold, practicing on paper. We always work from the right edge of the chart. And by repetition, by you seeing this over and over, This is how you learn and put the knowledge into your subconscious. This is how we build trader intuition. We just got out of a great position trade in sugar, big time. All right. Now, one of the things you will learn about me is that we look at the charts in an all-encompassing point of view, looking at price action, price oscillator, and linkage between markets, which is huge in 21st century trading. If you're interested to taste a little bit about what I look at every single morning, I send a client email out called Rooster Call. Go to hitthemarktrading.com and you can sign up for the Rooster Call. Go to the contact page. No credit card required, but I enjoy writing and I enjoy looking at what's been going on overnight, and then I write about it. Okay? And it's kind of geared to the day trader, but it's good for any kind of trader. Beware, it is a little bit opinionated. Okay? Sometimes a little cynical. I am holding a course which is going to talk about everything I talk about today. Again, you go to the website. It's July 11th through the 13th, 2 hours each day. Okay, this is Eastern Standard Time. My position trading course is just called Boot Camp. I have recordings on that from March. I haven't scheduled a live session for that yet, another live session. Let's get on to the feature presentation. What is momentum trading? Now, momentum trading is the art of spotting a market ready to move, selecting a trade, entering the trade with confidence, and utilizing predetermined exit points. Momentum trading builds off a firm understanding of support and resistance, along with known areas price is attracted toward moving. Okay, so what we do with momentum trading is we're trading directionally, up or down, riding the price wave rather than reacting to what might happen. Usually this is accompanied by a price oscillator, and it's used for intraday or short-term trading holding over a few days or even a few weeks. Today we're going to talk about day trading. Now, intraday trading uses a daily chart for the big picture. Okay, if I were talking to you about position trading, I would say, okay, we use the daily chart for entry. We are watching the weekly, and once a month we're going to look at the monthly chart. Okay, but with day trading, everything is compressed, everything is condensed. This is critical to reaction time, right? You've got plenty of time to examine the charts while you're position trading. You can look at it overnight, over a drink or over a tea, make your decision, your analysis, but you don't have that luxury in day trading. In day trading, it's instant. It's like right now, where are we going? What do I have to go off of? Now, people always want to know what is the ideal short-term chart for tactical entries, and the rule of thumb is the more volatile the market, right, the smaller the time frame. Okay, so we know that markets move up and down and sideways. If the market is sideways, we are greatly challenged unless the range is large. Therefore, it is imperative to find moving markets. This means if you are an ES futures trader and that's all you do, you must expand your horizon at times to other instruments that are showing movement, or I promise you, you are going to be very frustrated. We've seen some extremely tight range, which reminds me of the first 2 weeks of August, but we've seen that, you know, throughout the entire spring. It's been, I think it's been a very huge challenge for the ES futures traders. I really do. And the beautiful thing about if you have a system that you like it, you trust it, and it's robust, is it's going to work on anything. So you really, if you are getting chopped up in the ES because it just is simply not moving, you really need to do yourself a favor and start practicing on something that's moving a little faster. Maybe it's the NQ. You know, the Russell 2000 is going to go back to the CME. Well, we're going to get back into trading the Russell 2000. That used to be bread and butter, okay? We're going to get back into that. I left the Russell 2000 when I had a 5-tick slippage, and then I saw there's absolutely no volume, okay? All right, so let's talk about, to identify trend, we're going to bracket price with trend lines on the daily chart and the intraday chart. And here's a critical understanding here. Price is simply going to bang back and forth between the trend lines, okay? How is that for high-level analysis? So the first thing we do, this is a GenaTrader chart, and just kind of ignore what's going on in the background. I do have everything programmed on a GenaTrader, but I just want to show you right now the price. So, you know, in one quick look, we can easily see, okay, there's no guesswork here. The trend is down. Okay, I see that. A little closer inspection, and I see that for position trading, January was tough. Absolutely was tough. It was sideways. So anyone trying to, this is crude by the way, anyone trying to trade crude, I mean, it was a day trader market. And I remember saying over and over and over, this is not a position trader market. This is a day trader market. We simply wait for that sideways channel to break. And guess what? We do the same thing on the day trading, or you will get chopped up. You will get frustrated. Now, I use a 10 range bar CL chart. If you're not familiar with range bars, a bar will print every time the price moves a range of 10 ticks. Okay, so that's $100 in CL. All right, so you know I'm looking at this, and one of the reasons we like this CL is because it's known to move. This is today's chart, by the way, last Friday and today's. So you can see, hey, there's range there. This thing wants to move. Okay, let me go back here. So if I'm gonna put trend lines on this, I think I've got a chart for that. Here we go. One thing about these trend lines is we're gonna spot the channels easily, whether they go up, down, or sideways. And here's one of the things I teach. We have a no-go rule. Generally speaking, if an instrument is trading in a range of $200 or less for day trading, this should be avoided. Sure, you can try to get lucky, and you can try to buy in there or sell, but chances are by the time you enter, it will turn against you, because I'm telling you, the range is simply too tight. There are people who will trade very nimble and maybe look for 3 ticks, okay? There are people that will trade these tight sideways ranges as regression trader analysis type people. And what I mean is it goes to the bottom and automatically they buy. Automatically. It goes to the top, automatically they sell. Okay? Let me show you what I mean by that. Let's see here. Coming up here. Okay. If you can see this area right here, let me get my pen. Whoops. Okay, beautiful. You see this sideways area right here? Now, what's the problem here? I mean, this is Friday. Friday in the summer is horrible. What some people will do is they will block this up, and then they actually trade this, and they're going for maybe 2-3 ticks. Okay? I maintain by the time you enter that trade, it will have already fallen and then get ready to move back up. So you're basically acting like a ping pong ball being banged around here. So the thing is, recognize it, don't get upset, and just let it break. Price must resolve these things. Here's one over here. Okay, everybody who's so anxious to trade, losing. Price has to resolve the issue. Meanwhile, in the bigger picture, we're able to draw some larger trend lines. Now, I would have probably had a line drawn like this earlier, you know, because I can start it over here and connect it here and connect it here. So it's meaningful when the line is broken. That's my point. It's meaningful when the line is broken. Understand that support and resistance, which is represented by these channel lines and these trend lines, this is huge. And we learned to identify probable areas price wants to touch over and over again. And there's other things we use as well for support and resistance. Now, let's get into the oscillator. And by the way, if you have any questions, please hold the questions to the end so I can focus on the presentation, and then I'll answer your question. Now, oscillators derive their power from price movement. So for this reason, you really need to understand how to read price action at support and resistance areas. It's just huge. And what you see happens is the oscillator will provide a trigger point for entry. Now, I've had people that use Market Profile work with me and say that we get in earlier. And I'm telling you, one of the reasons we get in earlier is because we are looking at this holistically, and we are looking at support and resistance and the oscillator. So here's what most traders, especially new traders, what they look like when they're trying to figure out which oscillator to use. Okay? Do you remember the old story about the 6 blind men? And they come up and each one feels a different part of the elephant, right? And they all know exactly, oh, I know what this is, I know what this is. Well, the same thing with trading. You get people that will get so hung up on a method, and this guy says, oh, MACD, this is MACD, it's the best. And this guy says, oh, I've got RSI here, and RSI works the best, okay? Percent R. Bollinger Bands, some expensive proprietary indicator, right, that you pay a lot of money for, right? Or slow stochastics. I mean, whatever. There are hundreds upon hundreds of indicators. Tons of oscillators exist. Everyone has their personal favorite. In the beginning, I used to, as a position trader, I used a lot of them. Slow stochastics, MACD, Williams percent R, RSI. I probably had the Bollinger Band. And the thing is, when they all line up, boom, time to take a trade. You can do that in position trading. Absolutely. You can do that in position trading. But you can't do that in day trading. Because in day trading, you're saying, well, I got my slow stochastic. It says go. I got my MACD. I'm waiting for MACD to give me the signal. I'm waiting for RSI to give me this. You know, I'm waiting, and suddenly the move hits, and you're left behind holding your hat in your hand. So at present, I use one indicator after years of trading and my desire to simplify, and I use the Commodity Channel Index. It's also called the CCI. Now here's your top secret information for attending today. Let's have an important understanding. In a strong momentum market, all price oscillators work. Everything works. The most expensive oscillator works. The cheap freebie oscillator works. You throw up a moving average cross. You pick whatever number you want. Pick it out of a hat. It is going to work. In a tight range market, all price oscillators lose their predictive value, and I'm telling you, all of them. So this is one more reason to monitor several markets looking for momentum. Now, what is the CCI? It's a commodity channel index. This is a price oscillator created by a gentleman named Mr. Donald Lambert. I met Mr. Lambert. Mr. Lambert himself is not a trader, okay? He's one of these, he's got the technology, the high-tech mind, and he loves numbers, and he fools around with numbers a lot. And so he created this index, and what we find that in a moving market, the CCI is shown to lead price. Now that's a very bold statement, but don't take my word for it. Check out John Murphy's take in his book, Technical Analysis of the Financial Markets. Okay, I read that entire book flying from Chicago to Japan, Singapore one time. All right, so this is page, I don't know what page this is, but this is in his book, page 239, there it is. And what I want you to notice is right here. I want to highlight this. Notice that the CCI turns before prices, at each top and bottom. Notice that the CCI turns before prices at each top and bottom. So what he is saying, and I'll show you how to read the histogram. What he is saying is CCI turns, price goes down. CCI turns, price goes down. CCI turns, price goes up. Right? CCI turns, price goes up. Beautiful. Fantastic. Love it. Now, the CCI is a price oscillator. All you need to know is that we are comparing price with a simple moving average over a selected time span. Mr. Lambert suggested a 20-day period. The 20-day period is default in charting packages, okay? Other people have modified Lambert's suggestion for intraday use using a 14. I've seen 6. I've seen 5. What we're going to use is 14. Now, how do you calculate this? How do you calculate the CCI? You don't worry about it, okay? The software platforms, the charting platforms have this task automated. The user defines the time period. So I'm going to show you the calculation. You can study this on your own time. If I look at something like this for too long, my eyes will cross and I'll start, I don't know, babbling. So freeze this if you're watching the recording, if it means a lot to you to calculate this by hand. Otherwise, understand that we are using CCI as visual traders. The CCI is plotted on a histogram. I'm going to show you the chart. 0 line represents major support and resistance. The 100 line and 150 line represents minor support and resistance. Okay, here we go. That beautiful AgenaTrader chart. Here's the 0 line. Let me get my bouncing ball here. Here's the 0 line. Okay. Here's the plus 100. What do we talk about? The 0 line was major support and resistance. 100 line is minor support and resistance. 150 is minor support and resistance. 200 is extremes. In other words, we don't expect it to hang out there very much. Looking below the 0 line, minus 100 is minor support and resistance. Minus 150 is minor support and resistance. And then 200, again, minus 200 is extremes. Now what we've done here at AgenaTrader is we color-coded this histogram, okay? And what it tells us is where our CCI bias is located, right? If we are printed 5 to 6 bars above the 0 line, then we have an upward bias according to the CCI. 5 or 6 bars below the zero line, we have a downward bias. So the first 5 bars, what is it? 1, 2, 3, 4, 4 bars are black. The decision bar is yellow. And once you print that, okay, we got an upward bias. CCI upward bias. Same thing on the downside. 4 bars black, yellow is the big decision, and then red says, okay, we have a downward bias according to CCI. So you see, this kind of an interpretation goes a lot deeper than what Mr. Lambert had first suggested. All right. Now I want to talk about a very easy pattern that you can start immediately testing. It's called the diagonal trendline break. It's very powerful. Auspicious. Auspicious means, uh-oh, something's going to happen. Something big could be happening. We're going to start drawing from the plus or minus 150 line. Now that's your rule as someone who is new to the CCI. You're going to start drawing from the plus or the minus 150 line. I'll show you. It's a simple concept. It works. And this diagonal trendline break is absolutely a wonderful tool. Remember, before I show you, that we're going to adjust for day trading 14 on that CCI from the default 20. We're going to adjust it down to 14. Now, what does that do? It gives us a quicker reading on the CCI. 14 bars have to pass instead of 20, right? Everything is condensed in day trading. We want smaller time frames in markets with good range. And also, I'm a big proponent to trade during the rush hour instead of all day, but quite frankly, lately, as in the last 3 months or more, the typical morning rush hour has been quite slow. It really has been for equity index futures. All right, so I'm going to show you the chart, but it's a great pattern for trading. The diagonal trendline break on the CCI. Now there are 4 other CCI patterns I use and I teach, along with other robust setups, filters, nuances, but I'd say 50% of the trades are accomplished with the diagonal trendline break. You're getting that today for free. So this information allows for immediate testing. Draw your line at plus or minus 150 in markets showing momentum. Here we go. The blue line is 150, plus 150. So we start drawing from here. We extend it down. I like to have one touch. There it is. Start at 150, one touch. Okay, great. Extend it down. When it's broken, it is a buy signal. Hello, up we go. Diagonal trendline break. Up we go. Not much, but it went up. Okay, now this is probably about 1.48. So technically not 150, but hey, we're a discretionary trader. It's too close not to take it, right? So we draw it here. Here's a touch. Extend it out. Boom. We break it. Diagonal trendline break means the CCI breaks that diagonal trendline break we drew. What happens? Up we go. Here. Started below minus 150. Yes. Check. Got a touch here. Yes. Extend it up. We break. It's a sell signal. That's overnight. This is overnight, Sunday evening. Well, there's not much going on, but it did go down. But it's not really much going on. Maybe it'd be wise just to kind of put a box around this area. Wait for that box to resolve. Otherwise, you did get, for European traders and Asian traders, you did get a diagonal trendline break here Sunday evening. And I guess it's around almost 4 o'clock in the morning to go short. Well, what a beautiful trade. Wunderbar. All right, here's another one, diagonal trend line break. We start it here, here's a touch, we break it here, up we go, not much, downtrend, right? We got that from the daily chart. This market's in a downtrend. We know that. Here from 150, we got a touch here, extend it up, go short. He says go short. Okay, boom, down we go. How simple is that? How simple is that? All right, diagonal trend line break with the trend. You can certainly learn counter trend only after you've mastered trend trading. Now let me give you a secret here. I am the world's largest skeptic. You'll see that reflected in my writing. I am a skeptic. So for 1 year, I had to prove this to myself. And every day, I print off the chart in black and white after sitting there for what, 8 hours? You sit there 8 hours. Well, I'd take a break, then come back, print the chart, and I'd take a pencil and ruler to convince my subconscious mind, right, to convince me this stuff really works. And I was so pleased with the result, I dropped everything else. So I've got no reason to tell you anything false here. Try it for yourself. You don't need to take a whole year. You can certainly do back testing. Draw this from the plus or minus 150 line. You can use a confirmation price bar close unless the trend is really strong. What is a confirmation price bar? Well, if you know you're trading in a good range, you get the signal. That signal bar prints, and then you say, I want one more bar to go in that direction. And then boom, take the trade. All right, intraday. Here's your protective stop rules. Intraday. If you're going to go long, let me suggest you place your stop below the trigger price bar. Or in day trading, the prior bar to the trigger bar. So whoever is lower, that's where you want to put your protective stop. Initial protective stop. Now this means if I'm working with a 10 range bar chart, that I'm talking about $200, $220 initial protective stop. That means I'm totally comfortable. If I get whacked out, I get whacked out. Okay? That's very important that you have to understand. Nothing is 100% in day trading. These people that try to trade crude on a 6-tick stop and say that they're successful, I have a very difficult time believing that. Intraday. Same thing, just reverse what we're doing here. If you're going to go short, you place your stop above the trigger price bar or the prior price bar to the trigger bar. Okay? Whoever's higher. And quite frankly, this has been the best initial stop I've ever found. Now let me just show you that in action. Okay? All right. Get my pen. Choose pen color. Okay, I'm going to purple. Let's see here. Here's my trigger bar. The bar previous is lower. So the initial stop is going to go right there, just underneath that. Here's the signal to go long. This is the trigger bar. It looks like he is actually lower than the prior, so the initial stop goes below the sky. Here we go. Here's the signal bar. We've got this previous bar is lower. That's your initial stop. Wow, hello. Goodness. I like it. Here's a short signal. It looks like the previous bar and the trigger bar. Here's trigger bar. T for trigger. Looks like they're about the same, so put your stop just above there. Now, if you waited, you got stopped out over here. That's fine, because you got another signal to go short. That protective stop goes just above this bar. And guess what? You're in that trade. Hello. Just beautiful. Now here we go again. Here's the trigger bar. Here is the previous bar, but then you say, wait a minute. Next bar is red. Do I want to go in? Does it make sense? So maybe you wouldn't take that trade. This is, it could also be one of those things where trades where you get in and suddenly for some unknown reason, it stops. It stops. It simply goes sideways. No problem. There's always another bus coming down the street. Guess what? Diagonal trend line break. Here's the trigger bar, T for trigger. Put that protective stop initial right there, just above that. That works, right? I'll say, hello, captured the move. That's this morning's trading. Nice. All right. Now there are several profit considerations to choose from, including using profit targets. I decided over the weekend that when we trade equity index futures, from here on out, I think we're just going to use a very small target. We're not going to try to go for any runs because the daily chart continues telling us that we are in basically sideways markets on equity index futures. And in August, the first 2 weeks of August, we don't even trade equity index futures because it's useless. And you look back and you prove this to yourself. You look back at the chart. So in August, it'll be gold and crude. That's what we'll be trading in August. I already know that. Because the entire world is on vacation the first 2 weeks of August. Okay, so profit targets you can use. If the CCI has started turning back, say if you are long and it goes back at the 150 line, crosses it and starts going back towards zero line, that's your first shot across the bow. Hey, I've broken back through minor resistance. There's a little weakness in momentum. Maybe you want to take a profit. If the CCI crosses the 100 line going towards zero and you were long, you need to get out of that trade, right? You've now broken through 2 minor resistance lines. If you are in a trade and you touch a price channel line, we have another very, very, how to put this, very highly thought out approach to channel lines. And we believe a channel line holds until it doesn't. Okay? Everything we do is simple because most of the time the channel line holds. So therefore, price going to a channel line is a profit target, a profit-taking opportunity. Now, the most difficult task I have, entries are easy. The most difficult task I have is trying to teach exits because everyone has a different attitude toward money, toward risk. Everyone has different account size, all right? And so this is a deeply personal issue, how you're going to take your profits. As a very general rule in day trading, the secret is not winning big, expecting every move is going to make $1,000. The secret is converting small wins, right? You take winning small and winning often. and then you string together, you weave this tapestry, you string together a series of short duration, high profit probability trades. This is the true secret of day trading. I'm guilty of trying to catch that trade that goes out of the ballpark. But yet, I'm also realistic, and we will adjust if we're taking targets, absolutely. Or we will change our trailing stop. Now, one thing I want to show you that we've got built into the Agena Trader platform is a trailing stop system, okay? And the trailing stop is only going to take you out if price closes, for example in this long, below the trailing stop. Then you're taken out. If it touches it, you're still in. If it closes below it, you're out if you're in a long trade. So here's a great example right here. Whoops, I'm out. Long trade, hey, I'm out. New long trade, I'm in. Okay? So this is all done for you in the Agena Trader package. I've got this add-on, but it gets better. Everything that we do, all the nuances, the different patterns, including market structure, is coded into this thing. And now we suddenly have signals. Here says, hey, take a long. Here says, hey, take a long. Well, guess what? That didn't work. Wouldn't it be great if everything worked? I'm sorry, it doesn't work that way. You ever play cards? You ever go to the casino? You ever play blackjack? You ever watch someone who really knows how to play blackjack? I've seen a guy play for 4 hours, drinking coffee only. He has a system. And he walks away after 4 hours with $1,500 because he has a system. That means he has losses. There is not ever a 100% winning trading system. I'm sorry, it doesn't exist. It's a series of trades, and it's over time. So, this says what? Go long right here, go long. Well, boom, here you go. There's your signal. This says what? Go short. Okay, go short. Go short. Boom. How sweet. How simple. Nice. All right, let me get rid of this. Again, I've only got this programmed in Agena Trader. And the reason for that is because they've got what I believe is the best platform if you're going to get into semi-automated trading. Where basically you're handed these suggestions, you give it a look over and you say, hey, I agree with that. I'm the trader in command. I'm going to either take the trade or not take the trade. Okay? Good. My time, watching my time. Let me tell you, this is robust across any instrument. I don't care if you're trading cocoa, or you're trading sugar, or you're trading coffee, or you're trading bonds, or you're trading the ES, or you're trading the NQ, or you're trading corn, or you're trading wheat, or you're trading the British pound US dollar pair, or the euro US dollar, or the euro yen. I don't care. This is an incredible, robust system. And our mantra is, if an action repeats, we can trade it. Okay? If an action repeats, we can trade it. Now, I do prefer activity-based charts rather than time-based chart. A time-based chart says, for example, I'm going to look at my watch, and every 5 minutes a bar prints, and I'm going to make my trading decision on 5 minutes passing on the clock. Okay, I can't do that. And the reason I can't do that is because I have had extensive experience over, I don't know, year and a half, 2 years of automated trading, and empirically it is proven that activity-based trading for day trading gets you in earlier. If you wait for 5 minutes and that bar is big in that whole 5 minutes, and you say, okay, I got a signal. You get in, and I guarantee that big bar is going to correct a little bit, and it might take you out. So activity-based charts are going to be range bar charts, they're going to be tick charts, they're going to be volume charts. These are, I believe, better than time charts. Obviously, if you have only you can only use time charts, well, I'd probably drop to the 1 minute. Now, am I looking at other charts? Of course. I'll look at a 15-minute. I'll look at a 30-minute. Absolutely. And every morning I start the day with a day chart. But for tactical entry, it's going to be activity-based charts, and I think that can help you. Remember the no-go rules. I'm not interested to take a trade if the range is around $200. So that means I might get a beautiful signal, but I choose to let price resolve the issue, because the oscillators are going to be, or moving averages, you're going to get signals that are going to be fake outs. You can get chopped up. So just relax, sit back, let price resolve the chop. Remember that momentum traders believe they are for the long haul, taking a series of trades, converting to cash quickly. Runners can be for longer term moves. Trade multiple contracts rather than pin your hopes on a single contract. And please, paper trade prior to using any real money. And understand your ego, right? And anything demon in your mind. And trade with the weakness in mind. Your weakness is a reminder of what you've got to avoid. The day trading mind, fast action, and you're going to have fast profits or fast losses. You must react. Therefore, trade with clear charts. If you linger, you're going to miss the trade. Day trading is not position trading. The focus on day trading is knowing you have a winning edge over time. Therefore, the trading is never about one single trade. It is never about one day of trades. You do not judge yourself harshly if you have a day of losses. It is not about a week of trades, okay? You truly want to judge your system, look at your system over a 3-month period, okay? That's what I suggest. Now, I just said all this, okay. Remember, all day traders experience drawdown if markets simply are not moving. All of them. Listen, we're getting close on the time here, so are there any questions? Are there any questions at all that I need to answer? If you have any questions, let me know. Let me know if you have any questions whatsoever. Any questions? No? Okay, well, I've got some more minutes. I'll continue with what I'm talking about. I just want to make sure that I'm looking at all the right places for questions. Okay. Intraday trading runs price up and down. So the day traders got trend and counter trend trading strategies capturing these moves. The more you day trade, the more your system has a chance to prove itself, as long as you trade your plan as perfectly as possible. That is the big attraction to automated trading. Because the system, if you have your rules in a system, and their system says go, you quickly look at it, you remind yourself, hey, this is everything I would do. And you take the trade. If you feel the least bit like you don't want to take it, you're the trader in command. Okay? That's one of the things I like about that Agena Trader also. You can test new systems, your own systems. Now, the day trading mind, you've got to accept responsibility. How do you react under pressure of loss? Yes, it's being recorded. How are you going to react when a trade looks really, really strong? Are you going to move your original profit target, or are you going to follow your original plan? What if you move your profit targets and the trade reverses against you and you have a loss? How are you going to feel? Most people fail at day trading because they forget about thinking like an elephant. Remember, an elephant gets mighty big eating peanuts. The day trader capturing a series of trades and then leaving the game, waiting for the next trade, is happy, even if they miss the trade of the century. So with your day trading, just ask yourself a question. Can you quit while ahead? I mean, I've got a very dear friend of mine who had to quit trading because he had to make more. He had to make more. And it just blew him out repeatedly. So do you need just one more trade? Do you have to sit in front of that computer all day? You got to remember that professionals want your money. And the longer you trade, the more you can get sloppy. One more reason why a mechanical approach is better. Now, if a day trader makes $200 in one day, right, instead of everybody focusing on let's make $1,000 every day, what if you made $200 in one day? That's $1,000 in 5 days, right? 4 weeks of this, that's $4,000 a month, right? And then what do? Add contracts, make more. Well, that's the lure of trading. But once you start trading, the mind can become the enemy. So you've got to accept the mind games exist, and you've got to thwart the enemy. You really do. People blow up when making money because the money came too easily and they lost self-control. So the remedy to this is you trade as mechanical as possible, executing your trade as perfectly as possible according to your plan, and bingo, that brings us back to the idea of a semi-automated trading plan. You start with a small number of contracts and you build, regardless of your account size. I don't care if you've got all the money in the world, you start with a small number of contracts and you build and you prove yourself. You might want to tell your broker that you only want to trade X amount of contracts until you tell the broker otherwise. You say, I want you to shut me down if I lose X amount of money in one day. These are little tricks to control your account if your mind goes crazy. And believe me, your broker wants to help you stay in the game. So you ask what tools they might have to keep you from financially harming yourself. And understand, a broker-imposed limit like a daily risk level should not be relied upon as a stop order. I'm telling you. You can easily see price blow through a stop order, and you are liable. Today, overnight, gold fell 1% in a matter of seconds. So all those people who were long gold, if they had a stop, chances are it was blown through, and those people are responsible for that loss. Now, we buy into the dream of financial freedom through day trading, and the reality is this is a very tough business. Chance favors the prepared mind, so you control your mind or you immediately stop trading, and I mean that. Know your numbers. Consecutive wins, number of consecutive losses, day of week has proven empirically to be important. Do this for your trend trades and your counter trend strategies. Know what your win-loss ratio is over a minimum period of 3 months, okay? Some of these other measurements they can get pretty esoteric. I'm not going to worry about it. I want you to keep simple statistics to show you the robustness of your strategy. Do not complicate the record keeping or you simply will not do it, okay? All right, good. So I'm going to just leave you at this point. We've gone over our time here almost. Well, I don't know, 2 more minutes. I don't see any questions, so I'm going to just keep rambling on here. Know what your average profit is per trade, what your average loss per trade. Look at the charts of your losing trades. What's the basis of your protective stop? Is it just gut feel? What's the basis of, if you use targets, what's the basis of that? I got a friend of mine, he takes one off every 3 ticks, that's it. I said, well, why 3 ticks? And he said, oh, 3 is a lucky number. Okay, everybody's got their own quirk about trading. Okay. You got is your stop loss too small? Chop's going to kill you. Can you determine a maximum or favorable or maximum unfavorable price excursion? That just means, do you know that when NQ moves, it's certain to move a certain, at least 15 ticks, for example. We have a target on NQ of 15 and 30 ticks every time we go into trade. Okay, because that tends to be the maximum favorable overtime excursion. Okay. Protective stops are very personal. So you've got to figure out something that speaks to you. I can certainly make suggestions, but you've got to have something that speaks to you. Remember Goldilocks and the 3 bears? This one's too hot, this one's too cold, this one's just right. This one's too hard, this one's too soft, this one's just right. Your stop's got to speak to you. I think you need to base your stop on the mechanical chart action rather than emotion. I've shown that to you today. And I've shown you the one that I've got built in to a Gina Trader. Okay? My friend Charlie's 3 tick Charlie. He's always happy, constantly happy. He's in and out of the market. 3 ticks is nothing, but for him it's everything. I do think you need to log the time of day for your trades. I do think you need to log the day of the week. I've got the point now where I don't trade in the afternoon. Okay, I've put the time in to trading and sitting for 8 hours. I've done that. Been there, done that. It's no secret that a lot of new traders make money in the morning and lose it over lunch. That's the retail industry is known for that. It's no secret that Monday and Friday are slower than any other days of the week as a general rule, especially in the summer. As a general rule, there's obviously some days that are just stellar. I think the day trading game is best for visual traders who can react with a quiet confidence, knowing that losses are part of the game, and use clean charts for faster decisions. Remember, the day trader is no different than a professional poker player. It's not each hand that matters, but a series of hands played which determines the outcome. Now, I want to thank you for your patience, especially with the technical glitch we had first starting up. I want to thank again our host, Gina Trader. I appreciate the commitment to education. And remember, if you're interested for free access to Rooster Call, go to hitthemarktrading.com. And I think you're going to enjoy it. It'll take me about an hour and a half to write it. It'll take you 2 minutes to read it. I will let you know that if I've interested you with anything I've presented today, imagine what 6 hours of this is like, where I can really, really dig into it, total immersion, deep. So if you're interested in this, very reasonably priced course here, 6 hours, July 11 through the 13th, 2 hours each day. And with that, I'm going to let you go. Thank you so much. I will see you in July, and we're going to talk about swing trading. Thank you very much. Bye-bye now.